Today in our review for the SIE exam, we are tackling topic 42, direct participation programs, often called DPPs. These are unique investment structures, with the most common example being a limited partnership. Imagine a business venture, like developing a large apartment complex. A direct participation program allows investors to pool their money to fund this project and, in return, directly share in its potential profits and, importantly, its tax consequences. The core feature of a DPP is its pass-through taxation. This means the partnership itself pays no federal income tax. Instead, all income, gains, losses, deductions, and credits are passed directly to the investors, the partners, to be reported on their personal tax returns. This structure completely avoids the double taxation that affects shareholders of a C corporation, where the corporation pays tax on its profit and then shareholders pay tax again on their dividends. The structure of a limited partnership has two distinct types of partners, and the exam will absolutely require you to know the difference. First, there is the general partner, or GP. The GP is the active manager of the program. They make all the business decisions, from buying the land to hiring the contractors. Because they hold all the management authority, they also bear all the risk. The general partner has unlimited liability, which is a critical concept to understand. If the partnership is sued or goes bankrupt, the GP is personally on the hook for all of the partnership's debts. Creditors can go after the GP's personal assets. On the other side, we have the limited partners, or LPs. These are the passive investors. They provide the financial capital but are forbidden from having any management role. In exchange for giving up control, they are granted limited liability. This means the absolute most a limited partner can lose is the amount they invested. If the project fails, their personal assets are completely safe from the partnership's creditors. The SIE exam tests these concepts through scenario-based questions. A classic question might describe a limited partnership that defaults on its debt and asks who is liable for the amount owed. You must correctly identify that only the general partner has unlimited liability, while the limited partner's liability is capped at their investment. A common trap to watch for involves a limited partner overstepping their role. For instance, if a question states that a limited partner begins negotiating contracts on behalf of the partnership, they are acting as a manager. This action can cause them to lose their limited liability protection and be treated as a general partner in the eyes of the law. Another key point tested is the lack of liquidity. Unlike stocks, shares in a DPP are not easily sold, making them very illiquid investments. To help remember the key differences, use this simple mental shortcut. The general partner gets the grief and the power, meaning they have all the management power, but also all the potential grief from unlimited liability. The limited partner has limited problems because their liability and their involvement are both strictly limited. Remembering this distinction between the active, unlimited liability GP and the passive, limited liability LP is fundamental to mastering questions on direct participation programs.